So if someone asks a question, I will actually type here saying that please click on the YouTube icon. Logo. And whatever questions come in, I will open a fresh Word document, note it out. Resolution has to be how much? Huh? 240. Where do you do that? Settings. At least 240. If someone asks a question, I'll take control. Bottom right, settings icon, quality set to more than 240. You said, Guru.
Hi, good morning, everyone. Thank you for joining us on the webinar today. We will be starting in a couple of minutes. Thank you for staying online. Thank you for joining with us.
Nothing comes in between. Hey, don't lock it. Don't lock it. Ikra nahi karo.
Hello, good morning. My name is Sudarshan. I head the research at ArthaYantra, and I will be taking you through today's webinar. We are ArthaYantra, the world's only full-service robot advisory. And for today's webinar, we will be covering, we'll be following a pattern in our webinar. We first look at the global macroeconomy, we look at the Indian economy, and we look at a particular feature of the world economy as such that is affecting investments nowadays. And we look finally at the investment strategy. We start off with the global macroeconomy by looking at the developed economies. The biggest economy in the world, USA, has had a mixed economic outlook so far in August. Job additions were way below expectations. While economists had expected about 180,000 jobs to be added, only 151,000 were added. But however, if you look at the unemployment rate, it is at a healthy level of at little less than 5%. What's driving the US economy right now is the higher consumption. USA has always been a consumption driven economy and it continues to be so. USA has experienced a little bit of inflation in the real estate sector. This once again is a reflection of how good the consumption is in the US economy. The Federal Reserve of Atlanta, which is the equivalent of the RBI in India, has forecasted that the US GDP will grow by about 3.4% in the present quarter. And this is one of the highest forecasts that have been made in the past 3 years. Finance, uh, looking at the companies, we can see that not all the companies not all the industries are doing as well as each other. Finance industries companies uh, are performing quite well as their profits are increasing, whereas manufacturing or export dependent industries' margins are getting squeezed. Now, one of the reasons for this is the productivity of the employees is actually dropping. So the costs are rising for these manufacturing companies, whereas the prices are pretty stable, thereby squeezing their profits. The other biggest economic region in the world is the euro area. Uh, Germany and France continue to be the driver of the euro area. The composite PMI of Germany fell from 54.4 in July to 53.3 in August. So what this means is Germany's composite PMI is expanding, but the expansion has actually slowed down. The EFO business climate, which is the officially used business climate index of euro area, has fallen from 108.3 to 106.2. This shows that the German economy is growing, but it is also showing signs that this is losing a bit of steam. The April to June quarter GDP growth stood at about 0.4% against 0.7% the previous quarter. Another evidence suggesting that although there is expansion, it probably is not as healthy. Britain's PMI. Britain, as you know, had voted to exit from the European Union in the end of June. This had economic implications, and almost immediately, where the Bank of England had to declare a stimulus package and cut down on its interest rates to boost the British economy. Now, Britain's PMI was 48.8 in July. This is immediately after the Brexit. Uh, the forecast for August is fixed at 49.0. So what this means is the British economy is actually shrinking, but compared to July, it is shrinking at a much slower rate. This probably indicates that the British economy is showing signs of resilience. Britain, as in just like USA, is also a consumption-driven economy. During the 2008 and 2013 financial crisis of euro, Portugal, Italy, Greece, and Spain were classified as one of the biggest liabilities for the European Union. Now, outside of Greece, the other three countries have actually expanded. Uh, However, they also have their new share of problems now. Italy, which was one of the liabilities for the European Union area back then, had its manufacturing PMI for July at about 51.2. This is the lowest it's expanded in almost 1.5 years. But again, as we had mentioned before, it is an expansion. It's just not strong enough. Now, Italy, along with Portugal, is also facing a large number of non-performing assets. So we are looking at a potential bubble over there. And if steps are not taken to arrest this, we will have a repeat of the 2008 crisis, but probably of a much more higher impact. Now, unemployment in the euro area was about 10.1% in July. I'm sorry, July 2016. Now, compared to 1 year ago, it was at 10.8%, which means that employment opportunities are being added, or the number of people looking for employment has gone down. Either way, the unemployment number is a step in the positive direction. Japan is the foremost of the Asian economies, being the first developed economy in Asia. Now, Japan's GDP growth in last quarter was flat. It stood at about 0.2% annualized. But if you look at some of the other indicators, like Japan's unemployment rates, they were at 3% in July. This is the lowest it's been since 1993. And this despite having a stagnating economy, an economy that's probably clocked in single digit growth for most of the last 3 decades. Also, another indicator of Japan is the consumption, which grew by about 1.4%. This indicates that the economy is reviving. Now, uh, Abenomics, which is the economic package introduced by Prime Minister Shinzo Abe, uh, involves three arrows. One of the arrows is to boost consumption. This is a sort of an indicator of sorts that Abenomics is actually working in one sphere, which is primarily in consumption. Uh, we also had Japan attempting to pump in money in certain other spheres such as healthcare and pension schemes. This in turn is boosting, as initial reports would seem, that it is boosting the Japanese consumption. Now, Japanese companies have seen corporate profits rising, but the wage growth is not of much significance. Now, when we have low wage growth, the consumption gets affected in a different way. It leads to inflation numbers. So when we have increased wages, we have a higher ability of the consumers to spend, which leads to inflation. When we have not so significant wage growth, the inflation turns negative. Um, in Japan's case, there is a slight indication of inflation. As we have seen, there is a 1.4% increase in consumption, but uh, the inflation numbers do not seem to be at mark. The Bank of Japan set a target of about 2%, and the inflation is somewhere close to 0.1%. Moving on, we will look at how some of the uh, emerging economies are performing. The largest emerging economy in the world, China, had a stagnated expansion in August. The Caixin manufacturing PMI, which considers both government as well as private manufacturing, was at flat 50 in August compared to 50.6 in July. So what this means is uh, the manufacturing activity in China is not expanding, but it is not contracting either. But there is one thing which must be noted. China had the Bank of China and the government of China had initiated stimulus packages targeting infrastructure and and also lowered the yuan to boost exports. Now these have contributed a little bit to the expansion in the manufacturing. If this stimulus package was not taken, we would have seen the Chinese manufacturing activity shrink in August. Now, um, China is, well, if you look at the history of the Japanese economic growth, Japan expanded at quite a rapid pace, and at one point, when it faced stagnating economy, it had to pump in more credit. So what happened was Japan had to become more and more of credit-driven expansion. Now, if you look at the Chinese economy at the moment, we see that this it follows a pretty similar pattern. The Chinese government is backing debt, and this is creating an overcapacity. So investments are happening, capacity is increasing, but the utility of the capacity is actually pretty low. The global demand for China for goods as such has dropped, and this subdued demand is the biggest reason for the underutilization of capacity, and which is also responsible for the Chinese economy becoming increasingly debt driven. In the Asian Pacific economies, there are other economies that are also manufacturing backed, uh, that are also export backed. I'm sorry. These include Vietnam, Thailand, Philippines, and one of the most interesting economies to economists these days is Vietnam, because uh, it is also following a pattern that was followed by the Asian tigers, in which there was a high dependence on manufacturing and exports, leading to a very high GDP growth. Now, Vietnam's GDP grew by 6.7% in 2015, but unfortunately, because of the subdued demand, it's only expanded to grow by 6% this year. Now, for an emerging economy, that is a bit of a that is an expansion on the lower side. Now, Latin America has economies that are primarily commodity driven, meaning they exploit their natural resources and export them to boost their economy. Petroleum, oil, as you would know, has been in the doldrums lately. It fell for a continuous year and viewed a bit of a rallying in July. Now, during the time of its fall for over the past year, petroleum exporting economies like Venezuela and Brazil got affected quite badly, which is why Brazil and Venezuela are both in recession. The other commodities that are exported from Latin America include copper and tin. Peru, Chile, and Colombia are relatively better off because they are dependent on these commodities rather than oil. Chile, uh, which has which is quite an interesting economy, which was touted to be one of the emerging economies uh, of interest in Latin America, is expected to expand by only 1.3% this year. But this is despite the fact that it shrank by 0.2% in the quarter that ended June. The re- So, Latin America exports commodities, and the biggest buyer of commodities is the biggest manufacturer in the world, which is China. Now, because China can't export, it does not have the capacity to buy either. So, the entire economy of Latin America now depends on China. As we had discussed before, oil witnessed a rally in July, but it has been range bound throughout August. Now, because because the oil prices are below the $50 support mark, a lot of the oil-driven economies like Saudi Arabia, Nigeria, and Russia are all in deep financial problem. Saudi Arabia, although it is expanding, it is burning through its financial reserves, or its foreign reserves. Nigeria is in technical recession for the first time since the 1990s. And Russia, it's been in recession for a while and it continues to be so. Now, recent reports indicated that there has been a drop in the number of oil discoveries this year. So, what this indicates is that in the future there will be a possible reduced supply of oil, and this is not artificial, mind you. Uh, However, in such a scenario, when the supply is low, the prices of the oil will go up, and this can be seen historically during the 1970s oil crisis when OPEC, the oil producing and exporting countries, had placed an embargo on oil, shooting the prices up to almost $125 a barrel. Now, uh, in the future, because of the reduced oil discoveries, there will be a shortage of oil. But this will not be because of OPEC, but because there is reduced oil reserves as such. And when prices do go up, prices will not continue to grow because of the development of shale technology in the US and the Canada. So shale oil production typically is slightly costlier than the regular oil production. So when the prices of oil do increase, shale production will also resume. In which case, the production will increase, thereby matching the demand and supply, and thus keeping the oil prices range bound. Gold, gold has been the best performing asset over the last year, expanding to almost 25% annually. Now, uh, gold had rallied all the way till June, and after Brexit, it had gotten a boost. And economic indicators across the world, China's slowed economic growth, the weak economic indicators of Britain and Latin America not being strengthened, have all increased the investment in gold, contributing to a rally in the prices of gold. However, uh, the U.S. economy in July they recorded a stronger than expected job addition, indicating that uh, the U.S. was actually showing signs of revival. So this strengthened the dollar, and with the strengthening of the dollar, the gold prices came down. And these two factors have been contributing to gold prices being range bound. Now, with the data for August, the US Federal Reserve will be meeting to decide whether it is time to raise the interest rates of of the US Federal Reserve. In case the Federal Reserve does raise interest rates, the dollar will strengthen, thereby weakening gold. If it maintains status quo, dollar will strengthen. Now, other commodities in the market. Well, copper has been, if you look at industrial metals like copper, it was briefly range bound, primarily because there was a reduced production but also a drop in demand. China, the world's biggest buyer of copper, already has a high amount of copper in its inventory and will continue to, which is actually driving down the prices of copper. The copper was trading at about $4,607 a ton at the end of August, compared to about 4,700 at the beginning. Now, other industrial commodities like coal and some of the other industrial metals like zinc and tin have been rallying because there has been a increase, decrease in the production in the coal mines. Philippines had recently placed an embargo on tin mining because of environmental reasons. Now, we look at the economy that matters to us the most, India. Now, Indian economy grew by 7.1% in the quarter one, that is the April to June quarter. It's the slowest expansion in almost 6 quarters. If you would remember, in the last quarter of the financial year 2015-16, it had expanded by about 7.9%. India too is following a consumption economy growth. So we had the lower prices of goods and commodities in the global market actually helped the Indian consumption growth story. Manufacturing activity expanded in August. While it expanded by 51.8 in July, it expanded by 52.6 uh, in August. The services PMI stood at 54.7, the highest expansion since January 2013. Now, services is an indicator of how good our consumption is. And as you can see, the consumption story is reflected in the services PMI as well. The Indian rupee had strengthened against the dollar towards the end of August, primarily because of the weak US job data. The stronger rupee will make imports a lot more easier for India, and this will once again boost the consumption growth in India. Now, an interesting aspect of the current growth story is that uh, we had a drop in investments assets, investments through private means assets. So we had a lot of I mean uh, the non-performing asset news has been quite famous now, and I think Vijay Malia is kind of like the poster boy of how to be a baron at non-performing assets. Now, such major defaults are making banks a lot more hawkish at lending. So even if the RBI does cut down interest rates, the end banks may not necessarily do so because of the stringent non-performing asset targets that have been maintaining. So because of the high lending rates to the investors, private investment will get affected. So, for example, the private investment grew at 6.7% in quarter one of 2016-17 versus 6.9% for the same quarter one in 2015 and 16. So, if the investment is not growing uh, through private sector, the boost in investment has to come through the public, which is the government investments. Now, government investment has increased quite significantly. Um as we can see, the current account deficit for the quarter one of 2016-17 was at 3.93 lakh crores, or the equivalent of 73.3% of the budget estimates. This compared to the previous year of 69.3% for the same period. Now, this phenomenon is not strictly to India. Private investments have been falling across the world. So, um, in India, the private investment for the year 2015 and 16 was 1.4% less than what it was in the previous fiscal. If you look at the fixed asset percent investments in the US, it's dropped. So for the quarter ending in September of the year 2015, investment expansion actually shrank. It went to negative territory. And if you look at the China's fixed asset investments, it shows a steady decline. Japan's business spending fell by 0.4% in the previous quarter. But despite all of these uh, falling private investments, these economies are growing. Now, private investment is actually a very big component of each of the economies. Nearly 75% of India's private investments are through fixed or are through private holdings. Uh, USA's private investments fell because energy companies, oil mining companies, have put a hold on on buying rigs due to the low oil prices. Residential investments fell, but we will expect it to pick up in the coming months. The manufacturing PMI also fell. Of the manufacturing activity in USA for the August of this year stood at 49.4, meaning it shrank. Private investments as a percentage of GDP are a full 1% lesser than what it was the previous decade since 2008. Private economy contributes nearly 60% of the Chinese economy. China's private investments expanded by only about 2.1% last fiscal. Now, Japan, Japan being an export-oriented economy, with strengthening yen, its exports are getting hit. So companies are a lot more reluctant to invest. And this can also be seen in how the Japanese companies' profits are expanding, even though the actual wage growth is not. So, what is driving the investment story in all of these economies? It's a government. Public investments in India grew by 21% in the last fiscal year to year. Government spending in the first quarter alone was an all-time high of 3.5 lakh crores. So, if you look at China's investments, the fixed private investments grew by only 2.1%, but the overall fixed asset investments grew by 21.8%. And this primarily is through the government of China investing. Now, Japan, which has been through a chronic state of stagnation, had increased its government spending from 105 uh, increase its private investment to 105 trillion yen in the second quarter of 2016 from 104 trillion yen in the previous quarter. Now, USA, interestingly, has not seen a significant increase in its uh, public investments. However, it has invested heavily into the welfare sector. Now, the welfare sector in turn has contributed to the growth. Now, if the government of USA does decide to invest in infrastructure, the targeted means, it can actually help boost the productivity problem that USA is currently facing. So USA's productivity problem not only affects the short term but also the long term long term view. Because of the low productivity, we can expect only a lower expansion of the US economy in the coming years. However, a targeted infrastructure investment by the US government now can not only boost its short term GDP but also increase productivity, thereby boosting the long term GDP as well. Now, looking at all of this, we will look at how we should go about at investing. Government investments are driving growth across the world. So, holding government bonds for the longer term will be beneficial. So, uh, the 10 even though the 10-year government bond yields had been dropping in over the last week, the returns of the government 10-year government bond had increased from 7.01% to 7.11%. So we can actually expect to see some benefit of that. In the equity scheme, in equity side, uh, the government, because of its boost on infrastructure, will require companies such as cement or heavy industries like steel. Uh, in which case, companies that deal in cement or heavy industries will be beneficial. So it will be worth having exposure to these companies. Monsoon has been one of the biggest contributors to the Indian consumption story. Monsoon has been good this year, and it has improved the rural consumption. Automobile industries like Maruti Suzuki and Hyundai had a double-digit growth over the double-digit percentage growth over the last month due to the monsoons. Now we expect this to continue. So exposure to consumer goods will be beneficial. Finance depends a lot on commerce, and because of the consumption story, financial sectors will also grow. Now, the lower interest rates of central banks across the world will make gold attractive because uh, there are fewer schemes in which you can invest at the moment. Now, your portfolio's exposure to gold should not be more than about 5 to 10%, because gold should be more of a counterweight to losses rather than a pure form of investment. Now, holding foreign investments in the present scenario will depend a lot on with the government spending. You look to avoid economies which have low government expenditure. For example, Germany's government spending has dropped. There are indicators that the government, sorry, the German expansion might weaken in the coming quarters also. And as we had also seen, the Germany's PMI had dropped for the last month, and this is also a reflection of how the government spending is quite important for boosting the economy. USA's government spending at the moment, as we had said, is more on welfare schemes. Now, once the presidential elections conclude, the government will loosen its purse strings to invest in other sectors such as maybe infrastructure. But right now, uh, like in India, in the USA as well, uh, you pander to the masses, you get the votes. Avoid foreign equities whose government spending isn't focused on productivity improvement or on infrastructure at the moment. And with this, we reach the end of our presentation. Thank you very much for your participation. We are now open to questions. In case you do not have any questions immediately, you can also send your questions to research@ArthaYantra.com. Uh, right. We have Mr. Anji Reddy with the question. Right. In case, I mean, we are open to questions in both macro as well as related to investments as well. Uh, Mr. Anji Reddy's question was, may I ask any question? I mean, the type of questions that you may that we currently are inventing at the moment. Right. We have a question from one Mr. Vinay Gupta. According to our analysis, why are stock markets rallying so much at the moment? Well, as we had said, the consumption is what is driving the Indian economy at the moment. Monsoon has been good. We had consumer goods expanding, like we said, Maruti Suzuki, some of the other automobile companies are having a boost of almost a double-digit growth in their sales because of the increased consumption due to the monsoon. We have a question from Mr. Sanket Shah. He asks, is it still good to keep invested in mid caps and small caps, or is the rally already done there? Um, well, at ArthaYantra, we don't really believe in uh, timing the market because it is quite a difficult. Uh, it is actually very very difficult to do. So what we believe is in actually holding investments. So mid and small caps at the moment they are not. They don't seem to be demonstrating that much of a growth, but we believe it's only just a temporary phase. We expect that over time they will actually expand. So what would be best is to hold to your uh, no mid and small caps at the moment. We have another question from Mr. Sanket Shah. He asks, pharma and IT sectors have not done well recently. Should we take money out of these, or is it a good time to invest for long term? Um, well, recently there has been a rally in the Indian rupee compared to the US dollar. So what happens is uh, the IT and the pharma, which are primarily export driven, are facing a bit of challenge um, in the exports. Now, um, if the US Federal Reserve does increase the interest rates, what we can expect is a fall in the price of the rupee against the dollar, in which case exports from India will become attractive. So, pharma and IT will rally at that point. So, as of now, it will be more of a wait and watch. uh, we will not recommend any action immediately at the moment, because in case we do sell your stocks, in case you do sell your stocks now, and if the Federal Reserve immediately decides to raise the rates, these industries will rally, and you probably will not be just in time to invest in these. So it would be much better for you to hold it for the long term. However, we also would recommend that you diversify your portfolio outside just pharma and IT. Uh, it would be best for you to have a so we have a question from Mr. Anji Reddy, who asks whether UTI short-term income fund institutional growth option, is it a good one-time investment or not? Frankly, uh, we would recommend that you have a conversation with your financial planner, because we, as of now, I can't really tell what your risk type is and what your objectives are. So it would be better for you to have uh, a conversation with the financial planner to decide on your investment. Uh, we have a question from Mr. Krishna. Uh, Keeping view of anticipated changes in the market, would AY be suggesting new funds, either or new investments or reallocation? What are they? Uh, Yes, we are actually tracking the portfolios at the moment. We are looking at uh, the possible scenario outcomes. We are looking at whether you will have to like reshuffle your portfolio, or you'll have to buy new funds. Um, we are working on that at the moment, and we should be able to. We will be communicating these results to you through your financial planner in a while. We have another question from Mr. Sanket Shah. Uh, Regarding any investments for investing small part of portfolio in debt for a time horizon of 16 to 18 years. Um, so for a time horizon of 16 to 18 years, you would typically look for a long-term securities plan. We at Arthayantra, we at Arthayantra recommend Birla Sun Life Government Securities Fund. However, how it fits into the entire portfolio will depend entirely on your financial planner, and depending on your risk type. So it would be best for you to talk to to have a conversation with your financial planner, and they will be able to tell you what will be a best course of action for that. We have a question from Mr. Anurag Meena. What is your opinion about the ICICI Prudential IPO? Uh, well, we haven't quite really had an in-depth analysis of ICICI Prudential's IPO as such, but if we look at the background of ICICI Prudential, we've had. I mean, you can have a look that it has a backing of the largest private sector bank in India, and it also is um, it also is a growing part of the mutual fund industry, and also we can see that the ICICI Prudential mutual funds have had a sort of a average growth. So we honestly, at the moment, we can't really tell which way this particular IPO will go. So this once again will be sort of will be a bit of a wait and watch kind of analysis. Oh, for question from Mr. To question that Mr. Krishna Kankipati already asked, whether the regarding the portfolio, whether we will be recommending a reshuffle. Well, at ArthaYantra, we have a continuous review of your portfolio, and your portfolio management at ArthaYantra is uh, includes the reshuffle and the rejigging on almost continuous basis. So we will uh, we will be communicating any changes to your portfolio through your financial planner. Now, a question from Sir Sanket Shah: what is your opinion on so-called MNC funds? Should we invest in them? Uh, I I not quite sure what you mean by MNC funds, but if you are referring to uh, funds that invest in MNCs, then we would recommend you have a look at the underlying assets. So, for example, if you have an MNC, if the fund invest in MNCs that are uh, you know uh, are foreign based but are investing in India, we can expect a bit of growth over there. But if they are India based but then they expand to other economies, we can actually see we can actually see a bit of an expansion in that space. So I think we've had a. I think that's all the questions we have for now. If you have any more questions, please feel free to mail us at research@arthyantra.com. Thank you very much for your time. Thank you for joining us. Have a great day.